Thank you for joining in for this episode of the Coastal Conversation. I am sitting here with two of my colleagues and good buddies. I got Matt Chancey and Richard Hayes, part of the Coastal leadership team. So today we're going to talk about a couple particular tools that are utilized as tax strategies. You may or may not be familiar with them, but today we're going to start with 1031 exchanges. So, gentlemen, what is a 1031 exchange?
It's been around a long time. I would call it a mass market tax planning tool. It's fantastic because anything that allows you to keep some of your tax in your pocket and keep it on your balance sheet and keep it earning money for your family and your life, I think is a tremendous tool. It's subject to a lot of other issues like market conditions, but basically a 1031 allows you to roll a gain from a piece of real estate into another piece of real estate without paying any tax.
As you have accumulated your wealth, right? Some of that might be real estate. And we don't live on assets. We live on the income generated from assets. So if I've got some stabilized real estate that's kicking off cash flow, and I decide, maybe later in life that I want to exchange that real estate because I'm tired of the toilets, the tenants, and the trash. I'm going to manage real estate, which can, be a lot of work. The cash flow is great, but it can be a lot of work. Mm-hmm. Exchanging potentially and going from an active position in real estate where I am you're the landlord. I'm the landlord. I'm doing all the work, right? To a passive situation where I'm just cashing checks, right? But as they own it for a while, what happens to most real estate investors is it appreciates substantially in value. And then the first time they think, I'm going to manage this professionally and when I'm going to push rents on my tenants, well, then they try to push rents on somebody and somebody moves out. And they're like, whoa, wait a minute. Now they have to put capital expenditure into the real estate, commonly referred to as CapEx, to refresh it, right? Repaint it, recarpet it, put in new appliances, whatever. And then they have to re-tenant it and put a new person there, maybe marketing expenses, commissions to a real estate broker, expensive stuff to have to do. Plus, they probably lost rent for a few months. So in that scenario, they just never want the vacancy. They never want the CapEx. It's appreciated in value. So their concern then is when they go from, I don't want to do this anymore to I want to be more passive in my real estate. How do I get from active real estate I own to passive real estate just for cash flow that I may own, but I don't necessarily control the operations of, right? In a passive function, which is a lot of the things that Coastal Investment Company does, right? Yeah. Invest helps people access institutional real estate without having to be an institutional manager of real estate because we've got institutional partners, right?
It's not just an income producing property for a 1031.
No, great point. So I'm literally working with a client right now that is selling their business for like $8 million. Well, they own the industrial buildings that their businesses are in. And their business is worth their real estate's worth like $3 million separate from their business. So when they sold the business, they made an agreement with the person that bought it that they would let them be tenants in the real estate for the next 2 years. That was part of their agreement. So they're going to get lease payments from that new purchaser. But at the end of 2 years, they don't really want to be connected to that business in that way. So they're going to put that real estate on the market, potentially sell it. Well,
that's a perfect opportunity for a 1031 exchange.
And another nice thing about 1031s is they'll work for anyone in a large or a small transaction. They're not overly expensive to execute. They're not overly complicated. So you can defer a $200,000 gain or a $20 million gain. And it largely works the same way mechanically.
And I think it's a good thing for the audience to understand is, if you're going to be selling a piece of real estate for whatever reason it is, and you're going to consider a 1031 exchange, you should have a conversation with your professionals as soon as you're thinking about doing this, not afterwards. And there's a period of time where you actually have to execute that transaction. What is that period of time from when you sell a piece of property until you have to actually acquire the next?
But you can actually buy a property before you sell your gain property, or you can do a traditional 1031 transaction wherein you sell your property, lock up the funds, and then you have 45 days to identify and 180 days to close the transaction. So it's a hard stop. There are generally no exceptions.
A situation where there's not a good time for a 1031 besides there just being another alternative way to prevent
if you have an extremely high cost basis in the real estate that you're selling, like for example, if you're selling something for $1 million, but your cost basis in it is, $850,000, you would only be deferring, the $150,000 of potential gain, which at 20% taxes is a $30,000 tax bill,
you pay
right?
The tax.
You pay the tax. Why would I want to be encumbered by the restrictions of Code 1031 on $1 million of my capital for a $30,000 tax bill, right? Yeah. I would argue that if it's less than $100,000 tax bill, you want to strongly consider probably paying the tax, right? So depends on the facts and circumstances. I mean, we've done transactions on millions of dollars of real estate. So $100,000 tax bill is probably what you're going to get at around a $500,000, $400,000 to $500,000 transaction.
Yeah. Another important thing is, people that are selling businesses. A 1031 exchange used to be a tool when you sell a business asset. I'd like to know how long ago this changed, but now you cannot take a business asset and roll it into a 1031 exchange.
2017, I think is when they changed it.
Yep, 2017. Yeah, you could sell a business and roll through 1031 your business interest into real estate. Yeah, those were the heydays back in the day. That was great, right? Today, it's only real property. So it's real estate for real estate. And it's only investment or commercial real estate, by the way, too. You can't do this with a primary residence.
Yep.
So it doesn't work in that regard from that perspective. But yeah, so it applies to commercial and investment property. And I would say, if you're doing a transaction over $300,000, $400,000, $500,000, it starts to make a lot of sense to consider a 1031 exchange. If you're not super active in the real estate business and don't want to redeploy that capital back into your next deal, swap till you drop. So you 1031, and then when you die, all the taxes and the depreciation recapture, which is a form of taxation, gets wiped out of the transaction. And so your heirs can then sell that property at fair market value, pay absolutely no taxes.
When you sell a piece of property, you have recapture depreciation. Let's talk a little bit about that.
When you acquire a property, you sort of divide it up between structures and buildings and other sort of tangible assets and the land, which sits on your books and is not amortized or depreciated. When you write off over a period of years the building, that creates a deduction on your taxes. And because of that, the government wants you to recapture the gain from the sale of that building on a different tax rate. So capital gains is generally appreciation of property. Recapture is the tax on the depreciated part of a property. And Section 1250 recapture is 25%. Accelerated depreciation on any sort of smaller tangible assets can be ordinary income tax rates, 37%. What
is an example of some of the 1031 opportunities that Coastal is able to provide to our clients?
Well, a lot of any of the Coastal clients have seen the types of deals that we're doing, right? So those are just asset classes, right? Mm-hmm. An apartment complex is an asset class, a self-storage building, industrial warehousing, senior living, all those things are just asset classes. So those can be, those partnerships or those entities can be structured in such a way that they satisfied Code 1031 and make it eligible to be able to exchange in. So if you sell a prior property, you use a qualified intermediary, you never take constructive receipt of the funds, you roll it over to the QI, you did have 45 days to identify, with those type products, we constantly have something that's on the shelf, that's due diligence, that's vetted out, that's ready to exchange.
I sell a piece of real estate and I'm at day 30. I haven't identified something. Can I call Coastal and say, hey, I have this cash that's with my qualified professional. I haven't taken it yet. Can I put it into one of Coastal's funds?
Almost all the products that we manufacture, when they become fully stabilized cash flowing assets, and we exit those transactions and split partnership returns, right? Somebody acquires those and those become cash flowing assets many times that other investors that have 1031 exchange needs to preserve their stepped up basis and take passive cash flow can exchange into. That is a potential exit strategy for the product. It's a development product over here. It's stabilized cash flow real estate over here. So
that's the one that we can invest in.
This is the one that we can exchange into. This is the one that we put our money into and we watch our money turn into more money while we build it. But when it turns into fully stabilized real estate, it becomes an exchangeable asset.
Let's talk about another strategy. It's I don't want to call it a buzzword, but I've seen it thrown around a lot more within the past 5-6 years. Opportunity zones. Opportunity zones are also a tax strategy.
So another reason why you might skip a 1031 is, let's say you're selling a piece of property for $3 million and you've got unrecovered basis of $1 million. So in a 1031, to defer all of the gain, you have to buy a property that costs equal or more than the original, the sale price. So what that means is you have to invest the entire $3 million, even though you have $1 million of unrecovered basis. An opportunity zone allows you to defer only the portion of the cash that represents gain and withdraw, in this case, $1 million in cash, tax-free. So this is an example of when you have the complete conversation. You say a 1031 will work, but you can generally project a higher rate of return on an opportunity zone because of the type of asset they invest in typically, and you can get cash out at closing and pay no tax.
So the reason that they create these codes are based on the concept of growth and economic expansion. If we let someone defer capital gains and not recognize it today, and then we control the method in which they redeploy that capital, we believe it's good for society as a whole. So the code's created under the spirit of economic growth and expansion. So because of that, there were 8,800 census tracts in the United States that the federal government allowed the state government to make a decision of where they wanted that capital to go. And if we put the capital there, and there was a whole bunch of rules, that there'd be substantial tax benefits. And primarily it was for building new real estate, because one of the primary pieces to the legislation was you had to do what's called a 100% improvement over basis, which means you couldn't buy a building for $9 million and put $1 million into it and make it worth $10 million and get opportunity zone benefits. But you could buy dirt for $1 million and turn it into a $10 million piece of real estate and get substantial tax benefits. So they wanted you to create new real estate in these very specific census tracts where they wanted growth and expansion of the local economy to kind of go.
So for business owners that are selling their business, an opportunity zone is a good opportunity.
No pun intended.
No pun intended.
Yeah. So look, you have some inventory, some receivables, some other things. So some of it's going to be treated like ordinary income. Some of it's going to be cost basis, and some of it's going to be capital gain. So you can bifurcate those layers and you can pull them all apart when you sell a business. So you can put the cost basis back in your pocket completely tax-free. You would only have to reinvest the capital gains dollars into an opportunity zone to be able to defer, reduce, or eliminate the taxation on that tranche of capital. And then the other parts of it that are treated as ordinary, there's other potential tools that you might use, and you could solve that problem in another way. But so it allows you to kind of pull that thing apart like a layer cake a little bit and just use the part of it that needs to be used to put it into an opportunity zone. And because there's so many different opportunity zone tracks out there that have different assets in those areas, you can completely build a diversified portfolio of opportunity zone assets to help mitigate the capital gains portion through redevelopment.
So generally speaking, if you sell anything that generates a capital gain, first of all, it's eligible to be rolled into an opportunity zone, and the gain is deferred until April 2027. That's how you get in the door. That's your price of admission. The real power of the strategies on the back end, we'll get into that. But the requirements work like this, and I'll simplify it. Whether it's an individually owned property or an entity, it changes the requirements. But generally, you have about 6 months to roll a gain into a qualified opportunity zone fund. So you don't have to escrow the money or set it aside. You just hang on to it, and then you can take your time, figure out what you want to put it into, and invest it. So let's jump into the back end of the strategy, which is really where the economic power is. So you defer your gain on the front end. This is a statute that goes back to 2017. So the initial statute said you defer your gain into the fund. That's you cannot put non-capital gain funds in an opportunity zone. It has to be capital gain. It can be anything that generates capital gain. Sale of stock, goodwill, real estate that generates capital gain.
Crypto.
Yep. Anything that's short-term or long-term capital gain, it qualifies. You defer on the front end the gain from that transaction until April of 2027. But the back half works like this. So now you've rolled your gain in and you're in a new investment, right? Mm-hmm. If you hold that investment for 10 years, you are permanently exempted from all tax on the gain from that investment. And that's capital gains as well as recapture. So it's a get out of tax jail free card. And some people describe opportunity zones as the most powerful and efficient tax strategy ever birthed, Section 1400Z. I don't know if I agree with that or not, but I don't know of any other strategies that create a tax-free exit.
I can walk in the door at Coastal, and you guys can help me find something that I can use to put that money into an opportunity zone.
We could help show you how the tax benefits are going to work on the capital that you have. And then we could help you build a diversified portfolio of opportunity zone assets that met your needs, right? Because there's, they certainly have substantial capital appreciation, but we had talked earlier in the conversation that we don't live on assets, we live on income from assets. Right. So if I sold my business and I lost my paycheck when I sold my business, I've got to find a way do some financial planning and the use of redeploying this capital to create some near-term income for me to live off of without cannibalizing my capital base.
But I think, so what we usually experience is you have the first conversation with someone about an opportunity zone, and they hear that they have to pay the tax on the capital gain in 2027. And they hear that it's a 10-year hold, and they might disengage at that point from the conversation. But the reality is that there are ways to create liquidity. There's ways to get cash out, depending on the fact pattern, tax-free. And so there are other ways when you get to the next level to mitigate those things. And then you take away that trepidation of some of the limits, and it's an incredibly powerful tool.